Okay guys, so in today's video I've got a really good trade I want to show you with the Canadian dollar against the euro and the Japanese yen. So I'm going to break down fundamentally why we are seeing the Canadian dollar really strengthen because of government bond yields going higher in Canada relative to Europe and Japan, and also how the higher oil price is really benefiting the Canadian dollar. Now I really want you to pay attention in this video, because if you can understand the correlation between bond yields, oil prices and the Canadian dollar, when you're comparing countries, this can really help to generate really good trade ideas in the market. So I've bought the Canadian dollar against the Japanese yen and I've sold the Canadian dollar against the euro. And with inflation expectations rising, the oil price going higher based on higher demand because of the vaccination program, hopefully this trade really does play out. So I want to share this with you before the trade really does take off in my favor, and hopefully I can do a recap at some point in the future and explain exactly how it played out after we done this video and seen how the market has reacted. So I hope this video makes sense. Enjoy the content, like, subscribe, get in contact, and remember you can come join my trading team and trade with me if you want to. So enjoy the content, guys. Okay guys, so in this video we're going to have a look at the Canadian dollar against the euro and the Japanese yen. Now guys, remember in previous videos I have been showing you why the Canadian dollar has been getting stronger, and there's two fundamental factors behind this trade: the oil price, which has a massive impact on the Canadian dollar, and more importantly the 10-year government bond yield in Canada has been rising because of inflation expectations in Canada's domestic economy. So there's two factors that does help the Canadian dollar get stronger in this environment. So let's have a look at the government bond yield first of all, which is very important to understand. We have seen the Canadian 10-year government bond yield rise from the beginning of the year, trading at around 0.70%, so nearly 1% interest paid on the government's 10-year bond yield, but we've seen the yield shoot up to 1.5%. So the interest rate on the government's debt has increased, and this has made buying Canadian government bonds more attractive relative to European government bonds, because as we know, in Europe we have the German government bond yield very low compared to Canada, only trading at the moment at minus 0.22%. So you get no interest if you park your money in any European government bonds. And again, as I was saying, we have seen the oil price shoot higher. Now, oil accounts for 20% of Canada's exports. So when the oil price goes higher, this means the currency is in more demand and more money is coming into the country relative to how much money is going out of the country. And you get a fundamental reason behind the Canadian dollar getting stronger. So at this moment in time, guys, we're seeing the Canadian dollar getting stronger against the euro. Now, more importantly, remember, oil prices are forecast to continue to rise, especially after the European Union just signaled they're going to increase travel and tourism across the European Union and open up their borders to help countries like Greece, Spain, Italy from their economic hardship that's been caused by the pandemic. And this will cause oil prices to go higher because OPEC is cutting supply purposefully to allow their oil price to move higher as demand increases from the vaccination program being rolled out. So you have oil prices going higher, and you have the government bond yield on the Canadian bond is expected to continue to rise because inflation expectations in Canada are rising. You've seen inflation in Canada go from 0.7% up to 2.2%. That's headline inflation. That does include oil. So obviously we know why that's been going higher. Core inflation hasn't gone that much higher, but again, inflation now is creeping higher. Last month, inflation expectations was only 1.89%. It's already creeped up to 2.04%. So inflation expectations is rising. You know, inflation target by the central bank is 2%. So if you got inflation expected to be 2%, the yield is only 1.5%, and markets are going to push this yield up to 2% to make sure that their dollars are going to be protected from this expected inflation, and that should drive in the markets the Canadian dollar lower against the euro, which is already in a bear trend. So this is why I sold this currency pair this week based on this understanding, and we have a downside target around 138 in the exchange rate. We have a major support level at 143. Let's see if we can get past that level. The Canadian dollar is also getting stronger against the Japanese yen in the markets. Why? We understand clearly. Oil prices, yes, but exactly the same thing as we was looking at for Europe, the Japanese 10-year government bond yield is 0.09%. Massive difference compared to Canada. So if you're an investor in Europe, if you're an investor in Japan, you're not going to buy Japanese government bonds, you're not going to buy European bonds, but you may take your money elsewhere and find find another country paying a higher interest rate, and Canada is one of those countries. So there again is a fundamental reason behind the Canadian dollar getting stronger against the Japanese yen. And again, this is a really good buying opportunity in the market. So I really recommend jumping in. And remember, the average 1 month volatility on a stop loss is around 3%. So this is a really good trade to take in the market. So there you have it, guys. Euro CAD sell, CAD JPY buy. That's the fundamentals. That's what's driving markets. So I hope that makes sense. And take these trades, guys, or take these trades with me and my members, and we'll make some money together. So I hope that makes sense. Thank you for watching.